Welcome back to the Futures Edge podcast. I'm Jim Uriel. As always, the brains behind the operation, co-host Bob Iacchino. Today we have Shana, Orczyk, Sissel, founder, CEO of Bonrian. Did I say it right?
That is correct. And you said my maiden name the Polish way, which I fully appreciate.
I'm married to a Polish woman. I am steeped into the Chicago Polish tradition. So I take that serious. Yeah. So we played some games before. Let's get down to business. First of all, your favorite Chicago restaurant. Go.
Oh, wow. Lake Colonial is up there. But I would have to say Girl and the Goat is probably my all-time favorite.
So when you go to Lake Colonial, do you get the sea bass? Isn't that still their specialty? No, it's one of them, isn't it?
Yeah. It might very well be, but that's not what I get. I'm a huge fan of their pho.
Oh, fantastic. And what's your favorite drink?
Well, I don't drink alcohol. So I don't have a good, sexy answer to that. I love a good, really like a strawberry daiquiri, and you can make those virgin. So let's go with that.
Okay. What's your favorite movie?
Favorite movie? God, these questions are hard. Like, let's talk markets. That's easy. These are hard.
Our podcast is hard hitting.
Favorite movie? Okay. I have a couple, but I will say one that I can watch over and over again, never get sick of, is Crazy Stupid Love.
I've never seen Crazy Stupid Love. Bobby, do you have any questions for her?
You've never seen Crazy Stupid Love?
No, is it great?
It's amazing. It's Ryan Gosling, Steve Carell, Kevin Bacon. Like, how have you not seen this movie? Oh,
yeah. I'm sorry. I know the movie. I will watch it tonight. I swear to God.
Oh, my God. You have to watch it. Like, and I'm a big fan of Top Gun Maverick, too, but that just came out. So it feels kind of lame to say that's my favorite movie. So we'll go with Crazy Stupid Love.
A new movie, right? It's got to be something you've watched a million times.
Yeah. Crazy Stupid Love's probably right up there.
Yeah.
Okay. All right, good. I think those are all good answers. So let's move on to business stuff. So today we saw Jerome Powell. Okay. Mm-hmm. This was really weird to me in that several different Fed speakers over the last couple of days came out and spoke kind of hawkish. And then he comes out today and gives us the dove. And to me, I heard what he said. It sounded like pause to me. What the hell's going on?
So here's the thing. I can't argue for the Fed to become dovish when unemployment's at 3.4%, earnings are still okay, inflation is still sticky high, and if the Fed policy is inflation and then there's an employment aspect to it, I don't know how you can argue for them to become dovish, because the economy is still in okay shape. Unemployment is super low, and we still have 1.5 jobs for every one person looking. And so that's kind of what I struggle with. Like, companies have had like a year now where we've been talking about a recession. So they've sort of been preparing for a recession that hasn't come. So they laid off people, they shored up their balance sheets, they raised cash going into that. And so they're in pretty good shape. They seem to continue to have, cautious guidance, but that's only setting them up to outperform when they don't see the negative stuff come across. So I can't really make a great argument to suggest that the Fed should suddenly become super dovish. But I think the market wants the Fed to become dovish. So I think the Fed is somewhat talking to the market. Because that's what the market wants to hear. But what they should do and what they're saying are two different things. And they have been saying all along, remember, we are willing to put ourselves into a recession. We need to get inflation down, and the employment markets are really stable. And as long as that's the case, they will continue to maintain a tightening policy.
So Shana, I think there should be something in between hawk and dove, because to me, it's like they've nested.
Like the robin?
I mean, I don't think there's any guarantee. Well, they're a robin. There you go. Or like a small peregrine falcon, or I don't know. But like, you look at it from a perspective of what the market is pricing in. The market still, as of about a half an hour ago, highest probability is for a rate cut in November.
That's the craziest thing I've ever heard of.
It's crazy, right? But that's an improvement after the meeting of July.
If you really believe that the Fed is going to cut in November, people who think that, my question to them is, do you understand how bad things would have to get in the next 3 months for that to be the case? Like it would like everything would have to fall apart. Now, I'm not saying that can't happen. There's a lot of things that can cause things like a war, geopolitical stuff, but it would have to be an external factor, not something else, because there's no indications in like the financial system, despite what's happening with the banks, and we can go into that if you want, but there's nothing that I can see in like the broad macro environment outside of some crazy like geopolitical, like we get hit by an asteroid kind of thing that would warrant a rate cut. In order for there to be a rate cut, like everything would have to fall apart, like in a meaningful way. And so do you really, like my question to people who think there's going to be a rate cut, do you think that like unemployment is going to go to like 6%, inflation is going to fall to 3%, and suddenly S&P earnings and corporate earnings are going to fall 25%, and growth in the US is suddenly going to go from like flat to down 4%? Like, do you see that happening? Because that's the only scenario I could see a rate cut.
Okay. So you're talking to me here because I'm the rate cut guy.
Okay. You're the rate cut guy.
You glossed over the banking thing. So it sounds to me like you think they should go another 25 in June, and you think they will go another 25 in June. Is that accurate?
I think they should, but I don't know if they will.
Okay. So let's say they did. And the banks are a lot of banks are under stress. I mean, it's not, calling it a contagion seems weird, but giving people incentive to remove their deposits while they're still sucking on their long-term bonds.
But that's not the banks. That's the Fed and the Treasury having stupid policy. Like if Yellen had not gone up in front of Congress and said, oh, we're only going to protect JP Morgan and your little regional bank is screwed, like we wouldn't have this problem. The contagion is a result of like bad communication by the Treasury Secretary. If the Fed and the Treasury came out and said, as long as we have some instability in the banking system, we will do X, Y, Z, and not like caveated that with only the big guys who matter, like then we wouldn't have this problem. Like half the banks that are seeing problems, and I say this even about First Republic, are a fact that like optically they're going into these situations. Actually, they're not insolvent. They're not even illiquid. They have some mismatches, but the Fed came in and said, we'll buy your treasuries at par, blah, blah, blah. That should have been enough. But when the Treasury Secretary goes in front of Congress and says, we're not going to protect the depositors of like the small banks, like the depositors of the small banks see stuff going on and freak out and then go run to JP Morgan. And I don't care how solvent and liquid your bank is, if all your depositors flee at the same time, you're going down. And so that isn't a banks are insolvent. That's a shitty policy. But
you can say whatever words you want.
I know you guys told me I could cuss, and so I will. That's just shitty Treasury communication. And
do you think it was shitty communication, or do you think it was a message that I really think they want 10 banks? They want to nationalize the banking system. It's easier to do with 10 banks. We all read Carol's book, The War on Small Business. Isn't this just a manifestation of that, you think?
It could very well be. I'm not big conspiracy theory, but it certainly feels that way. I don't like that idea. That's bad. Remember in like the late 80s, early 90s when like, I remember I'm from Worcester, Massachusetts, like WCIS and Bank of Boston, like all these banks. And now like the only banks in Massachusetts are like Bank of America and TD and Santander, which used to be, can't remember what that used to be, but it wasn't always Santander, and like Citizens. There's like 5 banks in Massachusetts, right? But there used to be like WCIS and Bank of Boston, and like there used to be a million. So this happened in the late 80s, early 90s, right? And so if they're pushing people in that direction, that's fine, but that's not the banking system's insolvent because rates are going up in the economy. That's the banking system is being pushed in a way by policymakers, and this is what they want to happen. So why would they do anything policy-wise to prevent that? And I don't know if that does actually, banking's failing and people fleeing to larger depositors doesn't mean financial system crashes. I mean, JP Morgan, John Pierre Morgan would be so proud of Jamie Dimon for like holding the torch for saving the US economy in the banking system like he did in like the 1800s, you know?
Right. Mm-hmm.
So here's the shit I don't understand. Western Alliance had positive deposit inflows this week.
Mm-hmm.
Where did that money come from? Like, did people all of a sudden go, it's fine, I'm moving it from Bank of America back into my Western Alliance account? Are there people opening new accounts in Western Alliance? The whole thing seems screwy to me. And it doesn't seem to me like it's over, which leads me to my question. So I watched an interview with you talking about target earnings, and stop me anywhere I'm wrong, but I don't think you like Target. So I want to talk sector.
I don't like consumer
what do you like
discretionary.
about retail or don't like about retail?
Okay. So I'm not a big fan of retail stocks right now because consumer sentiment is largely negative, and some of the lower tier retail. So there's like this big divergence, right, between people with money and people without. There's still a ton of excess savings, like $1 trillion, but it's really concentrated in like people who really don't need savings, right? But the people on the lower end of the income spectrum are increasing their credit card debt. And there's some data that's starting to come out that's showing defaults on like consumer products is rising. And that's the lower end of the spectrum. So you have like this divergence between people who make money and have tons of savings, can spend money discretionary, and then like the lower side, which is starting to feel some level of stress. And Target falls into that bucket. And also Target's execution has sucked. Like absolutely sucked the last couple of quarters, and their margins are under pressure. So then there's that like company specific issues that I don't love. I'm not a big, so I don't invest in individual stocks broadly. So I'm not running portfolios of like hundreds of stocks. So if I'm going to look at an individual stock, I might have 10 names that I like at any given moment. I don't have to have a name in discretionary. And I don't have to have a name in retail. And so right now, I don't actually think that's a sector I want to be in. And I haven't even really looked to find anything that it might be interesting because I just don't think that I think there's too many headwinds to the sector for me to even bother. Because I could find a really cheap stock, but I could sit on it for a while before it worked.
So you mentioned the bifurcation of the economy, which I think is a topic we hit on here a lot. I think that over the last 3 years, the rich got richer, the poor are in the process of getting poorer with the inflation. M2 money supply. If it stayed on the ridiculously high trend that started in 2011, we'd be at about $18 trillion. With the $7 trillion they put in and then took money back, M2 has come down over 4%, but we still have $2 trillion extra dollars in the system. Is that the bullish fundamental case for the market as a whole?
I don't think it's a bullish fundamental case, but I think it's why it's taking so long for us to see any kind of contraction in the economy, right? I've said this before. I think I said it on Fox recently, where I said that, we've all been predicting a recession, right? Because rates are up and there's tightening credit conditions and the lower income individuals under pressure. But when you have that much excess liquidity in the system, you can stave off and the Fed can remain tight and not cut for a while because it will take a long, that has to come out of the system for the economy to start to really hurt. And the Fed has basically said, and that's also what kind of like keeps inflation sticky, right? Like you got to get the money out of the system somehow. And it's just going to take a long time. It's so much extra money in the system. We've had it decline, but it's still well above what it should be. And that's why I think we've all been expecting a recession to come and haven't seen it because it's taking a long time to get the excess liquidity out of the system. And it will eventually get out of the system. And when it does, we will see economic stress. Do you really think that's going to be by November to support the theory of rate cuts? Do you really think you're going to get that much liquidity out of the system by November to support rate cuts? That's my question.
Just because I'm scared, I'll say no. Right. Just today when he started talking about supply shocks, and then he started to talk about the pause, the S&P starts to come down. I said, this is stupid. And I bought a couple contracts and got my ass handed to me. Why did the stock suffer today when he basically was talking about pausing? What's the problem?
Because I think investors understand that that's not actually good policy. I believe
Okay.
that, it's bad policy to pause when inflation's still really high. You have tons of liquidity in the system. And if you pause now, you're actually like delaying the inevitable and possibly making it worse. And then the downside is worse. And so I actually think the market's not that dumb. Like, I think the market likes to hear like things that are going to be advantageous. But then like once they hear it and think about it, they realize this is really stupid. And I think that actually turning dovish and cutting rates, pausing is actually not good policy right now, and actually just is going to delay and make things worse in the long run. That's what happens. So I think that's what the market's reacting to, is like, okay, this is what we wanted you to say. Now you've said it and we've thought about it. Probably not smart.
So I think, Shana, that the market's dumb. To me, I'm gonna get so many people in my ass about this comment right now, but I mean,
The herds are dumb.
Yeah, well, it's just we had the 10-year jump up to 370. It was about 361 earlier in the morning, and that happened after the debt ceiling negotiations paused. And I really think, because what we saw selling of dollar assets, treasuries. We saw the yen go higher. We saw the Swiss go higher. We saw the tip gold went higher. We saw the typical flight to safety out of dollars kind of a trade because of the debt ceiling, which we all know damn well. Predicting that they're going to default is like predicting that we're not going to have a recession. It's like we haven't had all these signs are pointing to recession, that the Fed's actually engineered a soft landing once in like 60 years. Right.
I would argue once in its entire existence.
Yeah. Well, there you go. Okay. That's so more than
and it wasn't even intentional.
I'm in my 20s, so I don't remember any of that. Anyway, you don't believe that shit. So, when I looked at it today, I'm like, why is this stuff going down? And then I realized the yen was up, the dollar was down. I'm like, okay, people are actually trading off the debt ceiling. And this is what struck me with that tweet that you responded to today. Mm-hmm. Where I said, I don't understand people who are buying stocks right now. And I haven't participated, so I haven't made the money on the way up. Okay. But if you look at it from a perspective of, if you're buying stocks because you think the Fed's going to cut rates, but you also don't think there's a recession, you can't have both. So can you explain what you tweeted back? Because you kind of laid out a couple of scenarios.
Well, I basically said, I think that the Fed what did I say? Something about navigate a recession without cutting rates.
You said there could be a recession and they still wouldn't cut rates.
Yes, that's right. I actually can envision a scenario of that, which is we enter a recession. Remember, unemployment is a lagging indicator. So by the time unemployment hits 5%, we're already in the recession. But inflation's super sticky, right? You can't cut rates when inflation's at 5 and you're in a recession, because it's actually not going to help anything, right? Because you still got inflation at 5. Now, I could argue, and I actually think this is a valid argument, that like the 2% target is ridiculous because 2% isn't normal. We just got used to it for the last 10 years, but that's actually not normal, and it shouldn't be the target. Like the target should be historically normal inflation, which is like 3.5, right? Like that's normal. 2 is ridiculous because it's not normal, and it should never be a target. Like inflation is actually a good thing. It's like, right? The whole theory of why deflation is bad, because people won't buy today what they can buy tomorrow cheaper. Same thing with inflation. Like people will buy today because it'll be more expensive tomorrow. It's actually good for like economic growth to have a little bit of inflation. It also keeps interest rates at a reasonable amount so that you can manage risk. If they're too low, then people are, willing to take more like potential risk to get something. So, you got to be compensated for risk better. And so there's a lot of things to consider there, but I do envision a scenario where the answer isn't cutting rates, because that's a headline thing, but maybe it's like we start QE again. And that's like sneaky, right? Because I say that all the time. Like now that QE is on the table, you can keep rates where they're at, but still be, easing by implementing balance sheet expansion.
So saving face kind of without the headline lowering rates,
yes,
just doing it behind the scene. That actually makes a lot of sense to me.
Right.
We talked about the debt ceiling and the potential default, which I don't think is going to happen. And clearly the market doesn't either. If you guys remember back the last time when U.S. debt got downgraded, The net result of it was a little bit of a panic, and that people rushed in and bought bonds. The very thing that got downgraded proved to be the safe haven. Can you envision a scenario that if we did have a technical default, whatever the hell that means, we have a technical default, if there's a panic cause, all of a sudden people are looking for safety and they rush to the bonds that are being defaulted on? Shana, I want both of you to answer that. Shana first.
Yeah.
Easily, right?
I think we all believe that our politicians are stupid until it's bad for re-election, right? Like they'll stand their policy until all of a sudden it's bad for re-election rights. And a default would be bad for re-election. So now they want to be heroes and they'll get it done. That's how everything works. That's how it worked during the GFC. Remember, like, let's get this deal done. It didn't get done. Then everything crashed. It was like, oh no, market's down.
Oh shit, we gotta get a deal done.
Yeah. So like, I think we all know that. And like, for that reason alone, I think that's why it will happen. Also, keeping in mind, I was watching something the other day. I thought it was really interesting. Like we all focused on the yield curve inversion, right? So the 210 is what been inverted for
since July of last
13 months.
Year.
Yeah. 13, 14 months. It was made, the point was made to me that like actual recession start recessions don't start till the steepening begins.
Right.
The re-steepening, right? So like a curve can stay inverted for a really long time, but the recession doesn't actually happen until it re-steepens. So that actually supports what you're saying, is the re-steepening effect. So yeah, that's just my 2 cents there is I think the exact scenario is what would happen for sure. Maybe that's the opportunity in treasuries right now.
We did some research a while ago that showed that the stocks don't bottom until the curve uninverts.
Right.
So I actually have about a 3% target on the 10-year yield, which would fit in exactly with what Jimmy asked. I have a 3% target toward the end of the year, could be the first quarter of next year, but in a bear steepener, not in, a complete collapse into recession. Although I am in the recession camp. Again, I think we see all these recession indicators pointing toward a recession. Recessions generally don't start between like 12 and 18 months after the inversion, which we're about 13 or 14. So we're still in that window. And as you guys both mentioned, all that money that's floating around, of course, is going to slow it, but we're starting to see more applications for credit cards. We're starting to see defaults on car loans. We're starting to see defaults on credit card payments. And these things, even a hard landing begins as a soft landing. So my question is, if we go to a recession and inflation is still at 4%, what does somebody who does what you do first of all, explain what you do, and then what do you tell your clients then? Because we haven't even gotten into what you do.
So Bonnian works with advisors to help allocate and scale to alternative investments for their clients. Dude, that scenario is awesome for me because alts outperform.
What are alts?
Everything that's not long only equity and fixed income is alts. But to answer your question, things like global macro funds kill it in that environment. Managed futures kill it in that environment. Real assets kill it in that environment. Everything that I play in does better in that scenario. In fact, one of the reasons why liquid alts have never really gathered assets is because the SEC changed the rules that allowed for liquid alts to actually come into existence in 2007, right? So then mostly 2008 is when they were created. 2009, they did really well. 2009, people took interest and started to notice, and that was exactly when the market turned and went straight up. So why would you want a hedge product? And then you went then nobody wanted those products forever. And now people want those products. Oh, give me the scenario you're talking about, Bobby. And now I already have a lot of demand in my business. Give me that scenario. And there's liquid alts would benefit huge in that scenario and really show their value. So for me, what would I tell my clients? I tell them how I'm positioning right now. So we have market neutral, so zero beta stuff. And my favorite part about market neutral, and I use my favorite fund in the space is BTAL. Everybody knows this. I talk about it constantly because I'm infatuated with this product. Only because it's one of the few market neutral funds which I think does it right, which is it picks a factor that's relationship is persistent. So the cool thing about market neutral, right, is everything can go negative, but as long as what you're long goes less negative than what you're short, like you are positive. So I'm looking at market neutral. I'm looking at global macro. Look at GFC, global macro hedge funds were up like 50, 60%, like ridiculous. I'm looking at managed futures. I'm looking at real assets. I'm looking at gold. I'm looking at, glitter, which is the Aberdeen real asset funds that has some palladium and platinum and gold and silver in it. I am talking to and potentially working with a firm that's doing some cool stuff with diamonds. Like that would be cool. That would do well in that scenario. Like in that scenario, people start thinking end of the world kind of stuff. And, gold and diamonds are things that people will have value for, if like fiat money goes away. So these are things that I'd be thinking about, but that plays directly into my space. And so that would be great for me to show value for clients.
Glad we can help
like
you.
selfishly speaking, like your scenario is great for us.
Happy to help. Go ahead, Jim.
And that's what I talk about with clients now. Right now, the way we're positioned is to have that diversifier. I have a fund in there, MRSK, which is a hedged equity one, which has really good upside capture, like 85, 90% upside capture in case I'm wrong, but it has like only 40% downside capture. So I love that because if I'm right, it's mostly, if I'm right, I got downside protection. But if I'm wrong, and really that's my bigger concern, I get that equity beta that maybe I don't have under other scenarios. So I have that fund in there, but mostly I'm positioning for either a flat and volatile market, which is what we've been in, or downside. And in that case, the alt stuff that I do is what's going to work.
Okay, so did you guys see, I reposted it today. There was a chart that Tavi Costa, that's his name, right? I've met him before. He's a bright guy. He posted it was about the relationship between commodities to equities. And the chart goes, like this, like this, like this. And it's at like an all-time low commodity prices to equities, and it seems to be turning higher. I believe that. You mentioned gold, silver, platinum, palladium. I'm long all those things. I believe that commodities are going to go higher. One of the reasons I think, though, is that I think the government's going to do everything stupid to keep us from having a big economic boom that would benefit the equity market. But at the same time, then the Fed is going to eventually, maybe not in November, but eventually start pumping money back in the system. If you don't agree that there's going to be easy money at some time soon, what fuels that trade where commodities outperform stocks over the next 10 years, maybe?
Historically, commodities don't tend to have runs like that against stocks. Like that's inflation adjusted. Commodities don't tend to have like 10, 20-year runs of outperforming equities. That just doesn't happen.
What if it was a 2-year window, though?
So, you have everything you just talked about, but you also have supply demand dynamics that can make a big difference. Part of what's keeping the oil market somewhat stable is like weird government policy that isn't advantageous for old school fossil fuel oil companies, gas companies, which is the strangest thing in my mind, because like your policy is what's causing this problem. And then you get in front of these executives and blame them. Like they're the reason there's no supply. Like you told them. And like,
can I add something real quick? My favorite thing is that in the same week, about a year ago, they debated a bill to limit access to credit markets for fossil fuel companies, and then they called them, like you said, and asked them why they're not pumping more crude. I just wanted to get that in real quick.
It's like, let me restrict all the ways that you can pump more crude into the system, right? And then complain and reprimand you for not producing more crude, and then go out and tell taxpayers that you're doing it on purpose, right? Like it's the most ridiculous, illogical thing. And I wish people were like smart enough to realize that like 90% of what we hear from our government is like, psychological warfare. To try to like, because most people don't have the desire to go and like, I have a rule. This is my rule. I read a book called the Science of Fear a million years ago. There's an international version called The Science and It's Risk, The Science and Politics of Fear. It's the same book. The international version has 2 extra chapters because it's written later, but it's literally the same book. And what it made me do is now every time I have like a gut emotional reaction to a piece of news, I make myself figure out why it was positioned to me to make me emotional. And 9 times out of 10, it's because they want me to have an emotional response because I do stupid stuff when I'm acting on emotion. And so the second I start to research, like, what's the whole story, I realize that, like, it's nothing like what's being presented to me. This happens on both sides. It's not even like particular to one side or the other, both sides. And I wish more people did that, because that is, there's always a little bit of truth in everything. Like, yes, companies want to make money and have profits. Like, let's not kid ourselves. Yes, companies are going to pass along the cost of inflation as much as they can. Yes, that happens. But it's disingenuous to say that they're, doing things for, just for that, or that there's not policy behind it that's making things like that. It's never that simple. It's never that easy. And that's a perfect example of that. So I think we went off on a tangent. I don't even remember what the question was.
We love tangents. Neither do we.
Tangents are the best. Tangents are the best. Shana, how do you work with RIAs, right? Mm-hmm. Big groups of them, individuals, doesn't really matter to you, right?
Right. And I also work with alternative asset managers.
Okay. So you do have sort of a one level removed relationship with high net worth and to a certain degree, higher net worth retail. How do you so I had this experience last year. This is where this question is coming from. Okay. I have one of my businesses is a consulting business to smaller firms. Okay. And all I kept telling them last year, all I kept telling people in my family, what we did for ourselves, was we need to start getting out of risk assets because we've made too much money. Mm-hmm. And one of the interviews I saw with you, you talked about people chase returns. Return chasing is something I remember from my fund to funds days.
Everybody does.
And where you would have this performance where it's like, look, we're on a drawdown. We've had 10 years of good returns. Now's the time you should be investing. Oh, my other guy's doing great. He's just going to keep doing great. How do you get people to stop looking at things that way? Because if they did, there'd be no Bernie Madoffs.
That's a good question. I mean, I am always a big believer, if it looks too good to be true, it probably is. People, though, however, get like shiny object thing. The other problem is, and this is something I struggle with, I actually agree with you, but what is the quote from Keynes? You know what I'm saying? The economist. Yes. Something along the lines of better to be wrong with the crowd than right on your own. But there's the market can stay irrational longer than you can stay solvent. Like you can, both of these are relevant to what I'm about to say. So you can be right, but it can be a really unpopular reason to be right. And that can be problematic. Like think John Paulson and the GFC. And then there's the other problem of it makes total sense to get out of risk assets after 10 years of outperformance, but it's definitely going to continue to outperform longer than you think.
Right. You can't pick
and that happens all the time. That's why, as recently as 2020, I was still telling people, like, I'm not selling tech right now. Even though it looked inflated and whatever, like, I just couldn't see a scenario. Like, there were too many tailwinds, even though I still like NVIDIA, which, has a PE of like 183 and trading at a super premium. And people are like, well, it's a conglomerate now. Like, how much differentiation can it really get? I'm like, dude, it's the only one that does AI chips. Like, it has, and it's doing some other cool stuff. And like earning the E and the PE is only as good as your E estimate. And if that's way off, then who cares? Will Danoff said that once, and I thought that was really interesting because I think he's totally right. But my point here is that people are irrational on both sides. Like, and when you can be super rational, that's fine, and you'll usually be found to be right eventually. But it just like in this recession scenario, because we've been gone for a recession for like 12 months. I'm the first one to admit I thought we'd have had one already, but. I know it's coming. I just don't have any idea when. And I remember it was probably like right after the financial crisis, like 2010-ish, 2011. I remember Bill Egan had launched his JP Morgan Strategic Income Opportunities Fund, right? And like his whole thing was like, treasuries can't stay at zero forever. Like, I'm going to bet. And like, then 10 years, he was wrong. But his fundamental reasoning was completely valid, but like other things come into the mix. And I think sometimes I struggle with this because rationally, completely rationally, this makes sense, but like people aren't rational. And so the rational decision is always the right one. And things can get better or worse real quickly because of herd behavior, as we saw with banks. So I struggle with that myself. And being a little bit removed, I kind of always take that into consideration. Like, so I will make the case for why something should happen, but I'm also very cognizant of the fact that it's probably not going to happen when I think it is. And so I position accordingly. Like I tell people this is what you should be thinking. The good news is in the alt space, alts have worked even though this recession hasn't happened because markets are flat and volatile and fixed income and equity haven't worked. So that's been great for alts. So the last 2 years, liquid alts and alternatives in general have done really well. In terms of like the diversifying alts, like private equity, venture, that's different. And we won't go down that rabbit hole, but I think that that's kind of like, I always keep back of mind that whatever the rational thing is not going to happen as soon as it becomes obvious that it's irrational, because it's going to be irrational longer. That's why I used to cover value managers when I worked at Fidelity Strategic Advisors, and a lot of them would include, because most true value managers are anti-momentum, and that always kills them because they sell too early. So a lot of value managers at that time that I was talking to would put in a screen with their traders on momentum, where they would look at momentum factors, and even if the valuation was like unattractive and would say it was a screaming sell, if the momentum was like first or second decile, they wouldn't sell. That was the way that they kind of kept themselves. So like, I think you have to think in both fundamental and technical factors. So to your point with the risk assets, it depended on where you took your risk, right? Because if you were in tech, you may not have gotten killed. Yeah. If you were in meme stocks and Bitcoin, that's a different story.
So here's, when you look at this Carl Icahn thing, I don't know if either of you two are up to speed on it. If you're not, that's fine. But he got his ass handed to him, lost like $9 billion in shorting the market over the last year and a half. The market went down over the last year and a half. How the hell is that something like that happened? Do you know much about it, Shana?
I don't know much about it, but it's like anything. The market can be down, but how it went down matters. I was actually talking to someone today at this leadership retreat that I'm at, and he was saying that he was talking to a portfolio manager, and he was saying that the worst scenario for him as a manager is if it goes like this, right? Because you had no chance to dollar cost average, you had no chance to take tax losses, you had no, like, this is the worst scenario. The best scenario to make a lot of money is to go up, then crash, and then come back up, right? So if you're shorting the market and it goes down, but it goes down like up, down a little, up, down a little more, that will get you killed if you're just plain old short, because you're constantly going to have to cover your short on your margin. And that's why you're going to get killed.
Right. Plus, I think that, if you have good hedges on, and this, I've fallen victim to this before, and all of a sudden they become great hedges, you don't take them off in time. You know what I mean? Then I end up losing my ass on hedges. Bobby, how many times has that happened to you?
Yeah, a lot.
One of the best managers I ever covered, and they had a talent for this, but it wasn't like intentional talent. And I find that a lot of times that's the best managers. That's it. Like, they don't know why this worked. And I can like do the analysis on it and be like, this is what they're doing that's working. But they are not doing it like with the intention of doing it. One of the best managers I ever covered was a special situations deep value manager who always seemed to have their highest levels of cash at the best possible time because they just ran out of ideas that fit their scenario. But it was they were always building cash as we were about to like tank, so they could immediately put it back to work. But they weren't doing it on purpose. They weren't like, oh, I should have cash because the market's going to tank. They were raising cash because there was no special sits all of a sudden. And so they had nothing to invest in. And then they'd get in trouble with their investors and be like, why are you 40% cash right now? And they'd be like, because we can't find anything. And then they would get in trouble if they tried to just invest it in whatever, because that's not what they did. And then they'd inevitably make mistakes. But if you just watch their cash position over time, they always had maximum cash at the best possible moment. But it was never because they had this talent in calling anything. It was just the nature of what they were doing. I think there's something to that. I think sometimes we think like we try to be smart. And sometimes gut instinct, isn't there a Malcolm Gladwell book? I think it's called Blink, right? About this. Like sometimes you just have good gut instinct and you don't know why and you can't explain it, but you just know. And I think when it comes to investing and like timing stuff, like I can't say I get everything right. And I'm certainly not that smart, but sometimes things just make sense to me in my head and it ends up being the right call. And I've been right, thankfully, more times than I've been wrong. And that makes me happy, but I'm not smart. Anybody who watches me on TV knows that I'm not like the most articulate person. And I've certainly been called a bimbo more than once. But when I look back at stuff I've said, I'm right way more than I'm wrong. But it's not because it's not because I can articulate it in a way that makes people think I'm smart. I just, for whatever reason, have good instinct. And I think when it comes to trading, it's really hard to do that in trading, but I do think investors, in terms of like when they're not like feet to the fire, have to make a decision, can deal a little more on that gut instinct part. There are people that just have good instinct and they can't tell you why.
I think for me, I want to clarify two things. Number one, last year, telling people to get out of risk assets. I've never timed it so good before. So I don't want to act as if I, knew anything there. I get these feelings that things aren't right.
Right. But that's what I'm talking about.
Yeah, no, I know it, but it's always been more important to me so we talk about outperformance, and outperformance always seems to be, he made 30%, she made 40%, she outperformed. But I put more, and maybe it's the immigrant kid in me, Jimmy, we've talked about this before. I put more value, Shana, on outperformance to the downside than I do to the upside personally.
I do too. I actually think that. I do too. Maybe we have that immigrant kid thing in common. I'm first generation too. I don't know if that's valid as much by the average person though. I will say this. I think we get too caught up. I think the only people that care about like, did you outperform, are like the practitioners who are in like the trenches, like whether you're a trader or whether you're like a PM who's like entire like success is measured on, did you beat your peers, right? But like for my mom and dad, give a shit what their portfolio return. They just know, like, do I have enough money to reach whatever the goal is I am? I think we as practitioners who deal with folks are the reason they get so caught up on outperformance, right? Because we get caught up in it. But at the end of the day, most people just want to make sure they don't run out of money before they die. And that if they want to save money to buy a house or save money to send their kid to college, that when time comes to do that, the money's there. They don't care if that money happened to outperform by 10% or not. Like, we're the ones that put that in their head. They just care, can they do what they want to do? I personally think that like we get too caught up on that. But the answer to your question is the quickest way for that not to happen is to lose money,
right?
Not to not gain as much, right? So like the quickest way to not reach your goal is to take too much risk and lose too much money. Because now you got to make up like double as much. But like if you're up 20 and the other guy's up 30, you're still on track to reach your goal if all you needed was 10, right? So like it doesn't matter to you, but the quickest way to not reach your goal is to lose your money. As long as you're not losing money, it doesn't matter if you gain more money than the guy next to you.
That's the title.
But it matters to me because everything's competitive with me. I want to win. But my question though, so we've talked about a lot of things so far. And you talk about liquid alts, which I think is a fabulously interesting discussion. By the way, do you have a website where I can go and see kind of what products are available for possibly my
so
own
I
use?
can't say we have products per se. We're still very infancy startup mode, and we're trying to raise some capital so we can put our turnkey products out there. But yeah, just go bondrandcapital.com. We have a lot of content there, some research stuff. If you go to our YouTube, my favorite web series that we're doing, I'm super every time I tell people the title of it, they smile. But so we have 5 episodes of our web series called "You're Doing It All Wrong." So it's 6-minute videos taking on a
wordplay we love.
I know, I can't take credit for it. Our PR firm came up with that, but it's brilliant. And every time I say it, people love it. But they're 5 and 6-minute videos that take on one myth or misconception as it relates to alternatives. And so all our stuff's there. We're building some really cool things for advisors in terms of, we're working with access managers to build out our access platform. And we're really focusing on asset managers that are committed to working with advisors and will support and service advisors the way they need to be supported. And then we help, not acting as the middleman, because that's actually completely ineffective and not helpful to the advisors, but we help with the education, the research. We do the due diligence so advisors can feel really confident that these are our managers they can invest in with confidence. And then we spend a lot of time helping advisors figure out new and interesting ways to be able to have touch points with clients to grow and build their relationships, deepen the trust between them. So working with asset managers that have interesting product that we can create story around that gets people excited to want to invest in that space. And we have some models that you can just plug and play, which I think is sorely missing in this alt space. Too many people think you can just do one fund and that's enough, but would you just buy one equity fund? No, you wouldn't. You wouldn't buy one fixed income fund. You would build a portfolio. It's the same thing in alts. And then also getting into private equity is equity and private credit is credit, and they're not diversifying alts. And so they shouldn't belong in your alts bucket, even though they're relatively illiquid. That's a different conversation, but your betas, equity and credit. But that's neither here nor there. But you can find more information about all the different services we're offering as we're building it out. We haven't gone super strong to market for the REAs yet because we want to have the access platform really dialed in. And we have some really exciting tech stuff that we're working on that is going to change the game. And I don't want to beta test partly done tech with advisors when I know that we have something that we're on the brink of really being game changing. So you can go and find out more about what we're doing in that space. But one of the keys is liquid alts allow for scalability so that advisors can put alts in all portfolios. Because if you really want advisors or individuals in general to allocate to alts in the less liquid world, you got to make alts part of the daily conversation all the time, and liquid alts allow for that.
So I have a quick question for you. When you look, do you look at the broad equity market ever and decide if you're a bull or if you're a bear, and if the big overarching fundamental case or the overarching technical case as far as market positioning, do you look at that at all? Is it an appropriate question to ask you if you're bullish for the next 6 months, a year, 5 years?
Of course I do. My alts allocation, I'm not sitting here telling advisors to put all their money in alts. I'm just telling them that they should put money in alts. But tactical alts and what I would have in my alts portfolio at any given moment can change based on other factors. And what the equity and fixed income markets are doing matter. And being tactical in that space matters too. I think you should always have 20% in alts. But I'll give you an example. There was a point in time where I had a first trust commodity momentum strategy. I can't remember the name of it, but and I can't even remember the ticker because it's been a while. That we had this huge boom in commodities, and I sold out of it, and I went to FMF, which still gave me commodity exposure, but it was more long short because I thought the pure bull was out, and there was still opportunity, but I wanted to have the opportunity to go short. And so I switched it out and it ended up being the right call. FTGC, that's it. I think
we
that
love
was the
First
ticker.
Trust, by the way.
Yeah,
we know those
well,
guys.
they're in
awesome.
they're in Illinois and kind of our neck of the woods in Wheaton. I love them too. I think they have some great product, especially if you're in the liquid alt space. There's only a few firms that have like a nice suite of liquid alt products that I can use, and First Trust is one of them. AGF is another. Tays Group is another. And when I talk about liquid alts, I have a preference for stuff that are actually doing strategy, not replicating strategy. I really don't like replication alt strategies where they're trying to replicate a return stream using a regression analysis and just traditional derivatives. Like if I want equity market neutral, I want actual equity market neutral where they're long and short stocks and have a reason. If I want global macro, I want somebody that's actually doing global macro, not like derivatives to like replicate returns, because that never works in the long term because you're replicating based on past information. But that's neither here nor there. I just think that like I make decisions in my liquid alt portfolio based on conditions, and that's a perfect example. I added MRSK in the last 6 months because I was afraid after the recession that I was really expecting didn't come. I thought, well, maybe I might be wrong and I need something in here that will give me upside market exposure if I am wrong. But at the same time, it might be negative, but it will only be like if the market's down 10, it'll only be down 4. Like I'm okay with that. But I need to cover my ass in case I'm wrong. And so that's why MRSK went in there. If I was totally bearish on the market and I was convinced that it was going to go down, I wouldn't own MRSK. Like, why would I? Like, it will be down 4%. Like, I would rather have something like completely, negatively correlated instead, and not have the potential to have any negativity. But, I am tactical in my alts, and that is broadly a result of what I think is going on in the equity and fixed income markets. Like merger arb is a liquid alt, but merger arb only really works when equities are going straight up, right? Because that's when you start to see that kind of activity happening in the market. And private equity is leverage based. There's a leverage component. We don't say LBO anymore, but all private equity is LBO. So you got to have a low rate environment, and you got to have an active IPO market for that to be successful. So there's alts that I would be in certain market conditions that I wouldn't have in my portfolio if I was totally bearish. Does that make sense?
Very much so. I have 2 last questions for you, so I'm just going to ask them and then
go for it.
Let you roll, because I just like how you're cognitively complex, which I love. The first question is, where do you stand on the recession? I keep hearing people saying, where's this recession? Where's this recession? In 1966, it didn't snow in Chicago until January 7th, but everybody still knew it was going to snow. Mm-hmm. I think it was 2012. It was like 3 days after Christmas was the first time it snowed. I left Chicago 3 years ago, so I don't give a shit about that stuff anymore. But, you can have these things delayed and have them still be right. So where do you stand on the recession? Number one, I think I know. And then number 2, I want to know how you feel about commercial real estate, because it's been talked about a lot.
It's funny. My son's favorite sensei asked me that same question recently. Let's start with the first one.
Yeah.
I don't know when a recession is coming. I thought it was going to be second quarter of this year, and I was wrong. Now people are saying fourth quarter of this year. I think that's possible. I think a recession is coming. I think what the Fed decides to do will drive how soon that happens. If the Fed pauses, but inflation stays sticky, they might be able to hold it off a little bit, but then they're going to have to, when the economy doesn't go down the toilet, they're going to have to raise again, and that's going to put the pressure on. So I think that the recession might be delayed into the first quarter of 2024, which if you had asked me this a year ago, I would have laughed at you, but I actually think that is a feasible suggestion. I would be way more concerned if we didn't have a recession. People freak out about recessions, but that's a normal business cycle thing. And when you don't have normal recessions, you end up with what we have now, which is massive excess in the system, and then risk is way worse, because then when everything does go wrong, it goes really wrong, right? Like horrible like outcomes. I would rather see like a pretty like, you know, like shallow recession, you know, inflation at like 3.5, like mid 90s kind of recession. I would love to see that. That would make me the happiest person in the world. If that happened before the end of the year, I would be ecstatic. That to me is the best case scenario. Avoiding a recession right now and having some sort of soft landing and like tepid growth is like, to me, like the worst thing that can happen, because that means like 5 years from now, we're going to have like Great Depression Part 2. That to me is like, this is going to come to roost. And the longer we sit here and try to stave it off, the worse it's going to be when it finally hits us. You know, all we can hope is that like it's 50 years from now and I'm dead. But like, do you really want that? Like, it's coming. I just might not have to deal with it. And when it does come, it's going to be horrific. I would rather just see a really shallow recession and bounce right back. Like, that's totally normal. And that's a healthy business cycle, economic cycle. And not having that is not good. So that's how I feel about that. In terms of commercial real estate, my son's favorite sensei, my son, I'm in Illinois. I'm going to give them a little plug here because I have such good things to say about them. But my son goes to Fonseca martial arts here in Illinois. In the Chicago area, they have like 5 dojos. And the gentleman who started it is John Fonseca. And John's like a legend in the karate world. So my son competed in his first big AAU super regional tournament. And so we were doing some like special competition training, and that Sensei Fonseca was kind of leading. And after one of those events one day, the kids were all having like a pizza party. And John comes up to me and says, like, what are your thoughts on commercial real estate? So I've actually answered this question. And the fact that I'm getting questions from people who aren't in our business about this tells me that there's probably something here. My feeling on commercial real estate is there's some like really big structural changes that have happened that we have to consider. But I think that there's really tremendous opportunity in commercial real estate if you stay out of, say, office and like pure retail. I don't know if you drive through like some of the bigger cities or even like some of the nicer suburbs, you see a lot of like for lease signs that have been there for a while. And I don't know that there's a lot of demand right now, nor is the credit markets in this space open enough for people to sort of drive some of this stuff to kind of be resolved. In the office, work from home, back to the office thing, I actually think that's a structural change that we can't pretend that there's going to be a reversion to the mean here. So those are 2 places I wouldn't touch. But there are some awesome opportunities in commercial real estate if you like think more broadly. I think that triple net lease and anything that has to do with logistics and warehousing is huge. I think there's tremendous opportunity there. I think we learned a lot through the pandemic about improving efficiencies in the supply chain, and that's super advantageous. I think self-storage is also a place where I'd be super interested in right now, especially because we have like this weird supply demand problem in the housing market and people are not moving as much as they'd like. So a lot of times, like I had stuff in storage for 6 years, and there's always seems to be demand for that. So like self-storage, commercial warehouse space, triple net lease, that's super interesting to me. But I don't love pure retail and I don't love office at all.
Cool. All right. Let's wind it up. We've been going a while. I know you need your nap before you go to your dinner tonight. I'm going to take a nap too before I go to the bar. So thank you so much for being here. I think this was a ton of fun. Bobby, got anything else?
No, I'm good. Those are my final questions. I almost yelled out, how do you feel about real estate, specifically warehousing? But I cut my question off because I didn't want to feel like well, you're not going to listen to me anyway.
I mean, it's not sexy. Like if
no,
you own
but
like warehouse space, it's like
I love
Not
that
sexy at all, but
specific
that's where I would
area of
be.
commercial real estate. I really do.
Yeah.
Cool.
And I also, just to add on that before we end, I like logistics stuff, not on the coasts.
Mm.
Okay. I love to hear
Not
that. I
on
love
the
to hear
coasts.
plug for us flyover state people. Yeah.
Yeah, because the logistics, that end mile logistics is way more important than the port.
I want to get everybody who's been on the podcast down to Southwest Florida at some point. Just do a big thing. Just get them all down here. Have them all yelling, and Shana will be the only sober one. So just have them all just yelling at each other. It'll be fantastic.
There you go.
Shana will just be taking notes, going, "You're stupid. You're not." Perfect.
I get smarter after I start drinking vodka. You guys will see. At least I think. Have a great weekend, you guys. Okay.
Awesome. Thanks, guys.
Thanks, Shana.
Thank you.
Really appreciate it. That was really, really great.